Welcome to Yahoo Finance Live. Happy Monday. I am Shauna Smith along with Dave Briggs. Let's get you up to speed on this market action. We have stocks trading higher here after some of that anxiety over banks looks like it might be starting to calm just a bit. First thing helping soothe the markets was UBS agreeing to buy its rival Credit Suisse for more than $3 billion. Now there are reports of big bank CEOs discussing another way to help stabilize First Republic. We will get an analyst take on what is coming up.
The other big story, of course, is Amazon. The stock is trading slightly lower after the company announced it was laying off another 9,000 workers in its second round of job cuts. We'll have more details for you ahead.
But first, let's start with the big story of the day. And once again, that is banks. Starting with the regional plays, and you can see a bit of a mixed picture here. Actually, a number of some of these players trading to the upside today. The latest reports coming that Jamie Dimon and JP Morgan leading some of the talks with other big bank CEOs about a new effort to stabilize First Republic. Taking a look at First Republic shares, were halted a couple of times today, trading off just about 41%. So just off the lows of the session that the stock hit shortly after noon Eastern time. Some concern there about what needs to happen in order to stabilize First Republic and exactly what that situation looks like. You can see it's weighing on some of the other names within the sector, but a number of the regionals that have been under pressure for the last week and a half, 2 weeks or so, are actually trading to the upside. You have Pacific West up just about 9% today, PNC up just about 2.5%, Co-America trading up more than 3% today. So a bit of a mixed picture, but certainly First Republic, the underperformer there. And then let's take a look at some of the bigger banks. I mentioned that deal over in Switzerland over the weekend, UBS agreeing to buy Credit Suisse. And when you take a look at the performance of those two names, obviously Credit Suisse under a tremendous amount of pressure today, but UBS is holding on to gains. You can see it, the larger gainer of this group of stocks here. UBS up just about 4% today. So some reassurance in the market, but still lots of questions about what exactly the future looks like for the banking sector, more specifically, some of those regional plays. Let's dig into the turmoil that is playing out in the banking sector, starting with First Republic. Reports this afternoon that JP Morgan CEO Jamie Dimon leading the talks with other big bank CEOs on a new plan to aid the bank. Shares were off over 40%. We are just off the lows of the day as we kick off the final hour of trading. Now, the stock has certainly been on a steady slide ever since the collapse of Silicon Valley Bank. We want to bring in David Long, Raymond James Managing Director of Equity Research. David, it's great to see you. So ahead of this news today, you downgraded First Republic last week. Now there are reports of another effort underway to stabilize the bank. Is it necessary? What's your reaction to this report?
Sure. Well, if you take a step back and look at the news over the weekend that came with the Swiss banking system, with UBS sort of bailing out Credit Suisse, if you will, after a $50 billion injection last week, you look back at, or you look at the First Republic situation, and they got their own $30 billion infusion last week. And I think what this shows us is that this crisis is not over yet. And we've had step A by the regulators with the introduction of the Bank Term Funding Program. And that was supposed to give the depositors confidence that the banks would backstop deposits that were not insured. Then we had case B, or step B, I should say, with the injection of $30 billion into First Republic. And here we are today talking about potentially C with First Republic, as that $30 billion in deposits that came from the 11 larger banks may not be enough to keep them in good standings here. So Plan C could be some sort of equity injection, and maybe that deposit changes into an equity injection by these 11 banks. So this is being discussed right now, I believe, and maybe we'll know more after the close.
Are you surprised at the report from the Journal on JP Morgan it would not send shares back the other way and give the markets, give investors some relief?
Yeah, you know, these types of things typically happen when the market is closed. This must have leaked out. I would believe that if JP Morgan is involved and some of the other banks in discussions with First Republic on another type of bailout, if you will, these things typically you don't want to come out during the trading hours. As you can see, the stock down about 44% right now. That's something that we'd prefer having discussed in between market hours. But look, First Republic is in a tough situation. Their debt was downgraded a second time further into junk status on a Sunday afternoon. if you include the heightened funding costs for the bank and match that against their assets, it's not profitable. So they are in a bind. They need some help. And the rest of the banks, and I think the regulators, do not want to see another failure. So they're doing everything possible to stop that from happening here.
David, there was a group of the mid-sized banks who asked the government to insure all deposits for the next 2 years, something that might be being discussed right now. Do you think that's necessary in order to avoid a wider bank run in the future?
I sure think it could be necessary. We did not get that. That would have been the best case that Sunday night, I believe it was the 12th, when we were waiting for the Federal Reserve to react to the Silicon Valley Bank news. And it didn't come out then. We did not get the best case. That's something that's, I think, there must still be considering. And like I said, we may see step number C this afternoon or before the open tomorrow. There could be a D, and there's probably going to be an E. There will be other steps taken to stem the tide here. You know, the full deposit insurance, I don't think the regulators would like to go there. They'll get there if they have to, though. It seems like they try to react when they have to. And if they were to preempt that and had announced something over the weekend to insure the deposits, I think that could have spooked the market more than they wanted to before it really needed it.
If in fact, or when First Republic is shored up, do you presume that will stop this game of whack-a-mole and that we will level out in the days ahead, or will there just be one after the other?
Sure. I do think, as I said before, with First Republic, if you just do the math on their income statement and their balance sheet, it's very challenging to find a profit. They're really not profitable with the cost of their borrowing here. When I look at like a Pac West, which I published on this morning, I do cover that stock. Even with the heightened costs of borrowing right here, they can still make a profit. That's not the case for First Republic. So First Republic seems to be on paper the one that has the greatest risk. If this whack-a-mole continues, I don't know. It's all about confidence, depositor confidence. And I'm not sure what it's going to take. I've talked with some people that have indicated anecdotally that the amount of deposit insurance doesn't matter. They just want to feel safe with their bank. So even if the Fed were to step up with an increase in the FDIC insurance, I think that is a positive. But I'm not a psychologist, so I'm not sure how everyone's going to act with their own dollars, which they do want to protect as much as possible.
It certainly seems to be a crisis of confidence. I think that is very, very safe to say at this point. David, what does this lead, though? I guess how much has the game maybe changed for this group of stocks, for regionals, and are some in the position to capitalize on an event like this?
Sure. So we had 9 straight quarters of positive earnings revisions for the banks. In January, with the fourth quarter earnings releases, was the first quarter that we had net negative revisions for the banks. And we've been saying for several months that deposit costs are going to rise. Deposit betas could end up higher than expected. And this issue over the last 10 to 12 days has exacerbated that. So bank net interest margins are going to come down. Estimates are likely to come down pretty substantially for the bank space as we enter earnings season next month. As far as who's ready to benefit, I sure think some of the bigger banks are poised to benefit. And I think there are some regionals that can benefit from this. You know, if you want some ideas, I'll say Wells Fargo is one that I'm bullish on. I think they will be a winner out of this. And Wintrust Financial, WTFC, a local bank to me here in Chicago, they've got the set up very well to benefit from this with their the way that their deposit system is set up.
All right, good stuff. We appreciate that. David Long, thanks so much. So what's on deck for the Fed this week? Goldman Sachs now saying in light of the stress in the banking system, we no longer expect the FOMC to deliver a rate hike at its next meeting. That's on March 22nd. Citi and JP Morgan, meanwhile, do expect another 25-point hike. New data from CME's FedWatch tool revealing that nearly 3/4 of its market is anticipating a 25-point basis hike. Let's talk about that with EY Chief Economist Greg Dacko. Good to see you, my friend. What is your expectation at this next Fed meeting?
Well, I think it's likely that the Fed will proceed with a 25 basis point rate hike. As I've discussed in my recent note, I think the Fed is likely to approach a dual track approach, distinguishing financial stability tools from price stability tools. So wanting to keep that hawkish tone in terms of inflation. We know the Fed continues to view the data as being excessively hot on the inflation front, excessively tight on the labor market front. And I think that will likely push the Fed to proceed with a 25 basis point rate hike despite the stress.
Greg, will that be a mistake?
Yeah, I don't think that's necessarily the right way to proceed in the current environment. I think we would be better off essentially in an environment where there were a pause in the Fed tightening environment. We have, if you look at the totality of data, an environment where inflation is gradually cooling, where the labor market is also cooling. So from an economic perspective, we're seeing that momentum in the right direction. And then we have a lot of stress in terms of financial markets. It's not just domestic, it's international, and there is a risk of contagion. I've talked a lot about the fact that there are the known unknowns, but there are also the unknown unknowns, and those are the ones that can hurt. So there's nothing preventing really the Fed from taking a step back, holding back, pausing, even if it's a hawkish pause, and not providing any additional forward guidance. I think the dot plot in this current environment is really useless.
Even if it were no hike at this next meeting, do you believe that the terminal rate has changed at all so they'd resume the hike at the following meeting?
Well, I think, giving ourselves a little bit more breathing room in terms of observing the totality of economic data, observing how financial conditions evolve over the course of the next few weeks would just serve the right purpose in the current environment. We have a very fluid situation. And let's not forget, the Fed is not holding a dovish stance when it comes to monetary policy. It has tightened rates very aggressively over the course of the past year. We are now well into restrictive territory. So doing a rate hike at this point versus not doing one is not going to change the game in terms of the inflation outlook. It would just provide a little bit more breathing room to assess the need to tighten monetary policy further, to resolve the issue or the uncertainty with regards to the balance sheet runoff. And I don't think, again, providing any type of medium expectations for the federal funds rate will provide any help or guidance, useful guidance at this stage when it comes to interest rate projections.
Greg, how do you see the panic that we certainly have seen play out in the banking sector? How do you see that affecting economic activity up until this point?
Well, I think we know one thing for sure is that before this event, we were in an environment where economic growth was slowing. We were not in the midst of any type of retrenchment in private sector activity. We continue to see a labor market that was relatively resilient, still adding jobs, but there were decisions being made in terms of hiring, in terms of being careful about investment decisions. Those strategic decisions meant that we were in a slowing growth environment. And we were also noticing some cracks in the foundation of household finances. Credit conditions were something that I've mentioned in the past did warrant some attention. In the current environment, we're likely to see banks step back from credit, tighten standards even more, and be more careful with credit growth. And that is going to have a knock-on effect onto economic activity, likely shaving a few tenths if the situation doesn't worsen. But we are, again, in this very fluid situation where we have to be conscious that it could very well end in a better situation, but it could also end in a worse situation.
Has the last week to 10 days, Greg, changed your perception on the likelihood of a recession?
I think all else equal, it does increase the odds of a more pronounced slowdown in economic activity. I mean, we were already on the verge of seeing this near stall in the economy. If you look at final demand growth, excluding trade, excluding inventories, and excluding government, we were in a very soft position at the end of last year. This recent set of events is going to constrain credit growth, constrain consumer spending and business investment, and will increase the odds that we do end up in a recession. It could be a mild recession still, because there are a lot of backstop being taken very early on from the different monetary authorities around the world. But still, I do feel as though this type of environment increases the odds of a recession going into the rest of the year.
All right, Greg Dacko, always great to have you. Thanks so much.
Pleasure.
Well, we are just getting started here on Yahoo Finance Live. Coming up, another round of cuts in the tech sector. This time, Amazon announcing plans to lay off 9,000 more workers. We're going to get analyst reaction right after the break. Plus, Chinese President Xi Jinping had his meeting with Russian President Vladimir Putin. We will discuss what's at stake and what to expect from the three-day visit. And TikTok's CEO is heading to Capitol Hill this week as calls for a ban grow louder in Washington. We've got the latest ahead. Don't go anywhere. Shares of Amazon, they're off just about 2% here in the final hour of trading. Big news out today. CEO Andy Jassy announcing another round of layoffs. This time, the tech giant planning to cut 9,000 jobs. That's on top of the 18,000 that the company announced back in January. Joining us now is Tom Forte. He's D.A. Davidson's senior research analyst. And Tom, I know you're closely monitoring the hiring or laying off efforts that we have certainly seen at Amazon over the last several months. What do you make of today's announcement and how much that's really going to help improve their efficiency plan going forward?
Yeah, so I think what you're seeing in big tech in general is companies like Amazon, Alphabet, Meta Platforms, they're all trying to determine what is the proper amount of headcount for the current level of demand. And I think what you're seeing here with this announcement following the turmoil we've had in the banks is that there is some interrelation. So to the extent that the bank turmoil has a greater chance of resulting in either a recession or more significant recession, I think you can see another round of layoffs in big tech.
What's surprising about these cuts is they appear to be in some typically profitable areas, including advertising and Amazon Web Services. Why in those sectors, and your reaction to that?
So I think that's an excellent point. And what you saw in the earnings the last couple of quarters is that some of their more economically sensitive units that are the higher margin, faster growing, cloud computing and advertising, are starting to see slower growth. So on the cloud computing front, they give customers the opportunity to scale back usage as needed. So I think that this is a reflection of kind of what you saw in earnings the last 2 quarters, that the higher margin units were seeing slower growth because of the economy.
But aren't we seeing a slowing e-commerce business, leading one to believe where the hiring was ramped up is primarily in e-commerce and in warehouse? We're not seeing the layoffs there. Why?
Because I think that a lot of layoffs were done at the e-commerce level. So if you look in particular at the March quarter and the June quarter last year, they had about 100,000 attrition between those 2 quarters, and it was mostly not rehiring someone to replace someone who left at the fulfillment center level. So first you had the cuts at the fulfillment center level. Now you're starting to see them call it at the headquarter level.
Tom, you mentioned more cuts are likely in tech. Do you think even more cuts are likely at Amazon specifically?
Definitely. So if you think about Amazon's approach, generally speaking, they have an iterative approach where they'll try something and then they'll try it again and differently and things of that nature. But I do think that if the economy were to improve, then this could be the last round of cuts. But I think, unfortunately, the next step for the economy is a step down, and I think there could be more cuts at Amazon.
The stock, as we mentioned, down around 2%. Some feel that's at a reaction to a political story about Lina Khan and the FTC continuing to pursue Amazon, in particular, eyeing this iRobot deal. What is the uncertainty there? What is the impact of the Biden administration and Lina Khan looking into Amazon?
Yeah, so I think that there are some anti-competitive concerns for Amazon that are concerning, in particular to the extent that it uses its data to the disadvantage of the 58% of the third parties sold on the platform. Big tech in general, I think it's a worry, it's a risk, but I don't expect anything on a near-term basis. More interesting to see if they're going to ban TikTok right now than if they're going to limit Amazon.
Well, then why is the stock down?
I think the stock's down because this suggests that the March quarter is not very good. So the fact that here we are on March 20th and they're doing another round of layoffs suggests that things are not going very well at Amazon, including the higher margin businesses, cloud computing, and advertising.
What are you expecting from the March quarter? How bad could it potentially be?
I think there could be continued weakness in the quarter. We're about to publish a white paper where we look at e-commerce sales in general, and our thesis is that e-commerce in the future will grow at a slower rate. One reason is because the largest player, Amazon, is significantly scaling back its investment spending.
And you have, what's your rating and price target?
Buy rating and a $143 price target.
What's going to get it there? The catalyst?
I think what's going to get there is an improvement in the economy, and then to the extent that you see the consumers who are, or the businesses that are turning off their cloud computing, turning it back on and improving economy, but not margin expansion.
All right, Tom Forte, good to see you, sir. Appreciate that.
Thank you.
All right, coming up, the price of Bitcoin topping $27,000. Find out which exchanges are benefiting the most when we come back.
A big Fed interest rate decision, the state of the housing market, the TikTok CEO's first ever testimony before Congress. It's all coming up in the week ahead. Here is what you need to know. First up, February's existing home sales data will be released on Tuesday. In January, sales fell for the 12th month in a row, according to the National Association of Realtors, and given how mortgage rates have risen, it's likely that home sales will drop further. New home sales data will be released on Thursday. The focus will be on the Fed this week as Fed Chair Jerome Powell weighs whether or not to raise rates amid the banking turmoil. Some economists believe that the Silicon Valley Bank collapse will force a softer position on rate hikes. And Thursday, all eyes on TikTok, just not on the app. TikTok CEO Shou Chew will appear before the House Energy and Commerce Committee. Lawmakers are expected to grill him on TikTok's consumer privacy and data security practices, the platform's impact on kids, and the company's relationship with the Chinese Communist Party. This will be Chew's first testimony on Capitol Hill.
All right, let's get a quick check of the markets, 3:26 Eastern time. This one's sponsored by Tasty Trade. A lot of green on the board despite all the bank uncertainty and all the stresses on the system. The Dow up more than 1%, S&P up 27 points, and the NASDAQ just eking out gains for the day after a terrific week last week, best since January. Meanwhile, Bitcoin rising over the past week amid fears of contagion in the traditional banking system. And with the rise of Bitcoin price comes some of the familiar traits in crypto trading, like increased leverage. Our David Hollerith here to break it all down. David, we see Bitcoin up nearly 15% over the last 5 days. What's happening here below the surface?
Yeah, Dave, I mean, the question about, why people are buying is it's going to continue to be debated about whether or not it has to do with the Federal Reserve loosening their rate hike decision on Wednesday, or it has to do with the banking system and the fact that Bitcoin is just completely separated. But in the derivatives market, traders have been placing bets in the futures market at a elevated rate, a rate that has not been seen. It's only been seen one other time, since November. And then also in the options market, Deribit, which is sort of the main options platform for betting on which way Bitcoin will go, has sort of seen a surge in contracts over the last week. It's an all-time high as far as the amount of open interest they've seen go into their contracts. So what we're seeing is a lot more leverage building in the system right now. And we don't know which way that leverage is positioned. So there's, if we look at an outbreak, at least in the futures market, it looks about 51% long, 49% short. But we don't really, whatever happens to the downside or the upside, that's obviously might be decided on Wednesday. I'll also point to the fact that in the futures market, there's like a very large amount of futures contracts set to expire at the end of this month. So that's another thing to watch. And obviously the bulls, from how they're positioning their strike prices, are looking at the $30,000 mark for the target for where they're expecting Bitcoin to be around that time.
Sure would be interesting to see another surge. David Hollerith, appreciate that. Thanks so much. Coming up, shares of Bed Bath & Beyond fall below $1. See what the company did that's souring investor sentiment when we come back.
Time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading. We've got Bed Bath & Beyond, Foot Locker, and Starbucks. Let's kick it off with Bed Bath & Beyond. Once again, it is a top trending ticker here at Yahoo Finance. The retailer seeking approval for a reverse stock split. That actually sent shares plunging today. This isn't necessarily an outlier. A lot of times we do see this type of movement here. Now, what is under consideration from Bed Bath & Beyond is that it will be in a range of a 1-for-5 stock split or a 1-for-10 stock split. A lot of time this move is done to help boost the price of shares. We'll see whether or not that actually happens. CEO Sue Grove saying that the move, quote, will enable us to continue rebuilding liquidity to execute our turnaround plans and better position the company financially. They are trying to do everything they can to turn around the business, to put themselves in a better position financially. The street doesn't look too excited about this just yet, but we'll see whether or not it actually does boost shares.
Right, Sean. I mean, it's really about getting more capital if you're Bed Bath & Beyond, right? And you got to get that stock price up to do that. We know the deal that they have right now with funding coming from Hudson Bay requires the stock to stay above $1 in order or Hudson Bay can back out of the funding, the monthly funding of about $100 million that's going to Bed Bath & Beyond. So it's really sort of an effort potentially maybe to keep that stock price up, to keep investors interested. And that's, of course, institutional investors we're talking about, but Bed Bath & Beyond does have the retail trade too. And you wonder with the stock split, if the price were to go back up, would the meme play get involved? We've seen AMC sort of benefit from that to some extent, right, as the stock goes up. So I think that could be an interesting part of it, Dave. Of course, what they're trying to do with that money is get inventories back in and get stuff in the stores, right? And then they got to get me and you back in the stores. So certainly a long way to go. And even if things are back on the shelves, are we going back to Bed Bath & Beyond is the question.
What stores? I had 3. I have 0 now. They've announced last week closing an additional 400 and not offering severance to the employees in those stores. So still lacking an actual turnaround plan, to your point earlier, closing stores as well as your play as well, which I will discuss in a moment.
Foot Locker is closing some stores, but let's take a look at another part of the business first. Shares taking a step back as the company's 2023 guidance for same-store sales and adjusted EPS came in lower than Wall Street had been expecting. Now, the company also hosting its investor day with new CEO Mary Dillon, sporting a fresh pair of Nike Air Max 97s, detailing Foot Locker's new lace-up strategy. She talked about Foot Locker's long-standing place in sneaker culture. Again, those Air Max 97s, Dave, she was highlighting them. And the current connection to the younger consumer. About 66% of the company's buyers fall in the 18 to 34-year-old range. And I want to point out one slide shown during the investor day highlighting Foot Locker's plans to maintain a strong relationship with Nike while also growing revenues from other brands to about 40% of the company's revenue. Foot Locker also hoping to grow sales in its exclusive categories from 15% currently to 25% by 2026. So sort of playing up a space in that sneaker culture, Dave. I thought it was funny Mary Dillon highlighting those sneakers, but also just their role in sneaker culture that they feel like they've played and they belong in moving forward here.
You've got me Googling the Air Max 97, Josh. What is the new lace-up system? Is it no tying of the laces?
No, sorry. Lace-up
is
the plan that Foot Locker is calling their overall strategy. Air Max 97 is the shoe.
Right, but you don't tie them correctly. I know I'm getting us a bit off track here, but it does not appear
you're one of the
you could
sneakerheads
wear
here.
Air Max 97s without tying them.
I do.
Yeah.
Okay, yes, that's what
you could wear them without tying them. There wasn't a direct correlation there. I was more just going for she was wearing cool kicks.
Sorry, you got me distracted. I was
kicks.
checking them out. What jumped out to me was really the closures of 400, primarily mall stores, but also they hinted at opening 300 new concept stores, which is really interesting. And we're going to talk about this later in the program with the Build-A-Bear CEO. Malls were going through a really rough patch and then they became experiential. What Foot Locker appears to be doing is closing these 400 mall stores and opening experiential stores. I can't help but wonder if Build-A-Bear fits in the middle there where they are both. But they have these youth-related stores. They have stores where you can play games and get involved. And so it's an interesting play. But we also see inventory has been a problem for them, up 30% year over year from the quarter a year ago. And that's just been a story we have heard over and over and over again in the last year in retail.
Yeah, certainly something that Foot Locker and a number of other retailers are going to need to work out over the coming quarters. It's interesting also when you look at the street's reaction because they were pretty mixed, even though the Q4 numbers were very strong. Some questions about the outlook, how realistic some of their sales guidance is going to be over the next fiscal year. So I think that's part of the reason why we're seeing shares off just about 5% today.
Yeah, the stock was up quite a bit originally on the news, and then it fell back down towards the close. Okay, my play is Starbucks. The coffee giant's new CEO, Laxman Narasimhan, taking over for Howard Schultz about 2 weeks sooner than originally planned. Narasimhan was named the incoming CEO back in October of last year and has since shadowed Schultz, who stepped into the CEO role for the third, and he says final time in April. The handoff was slated for April 1st. In addition to taking over as CEO, Narasimhan joined the board on Monday. He will lead the company's annual shareholder meeting on Thursday. Schultz, for his part, is set to testify before the Senate on March 29th regarding Starbucks' ongoing unionization effort, which should be very interesting. I was trying to think if shares were a coffee drink. They're kind of a flat white, if you will, today. Also this year, not a whole lot of movement in 2023, a solid year last year. The big question for the new CEO will be what Howard Schultz is testifying on. It's that ongoing unionization effort and how they handle it. He clearly did his best to squash.
Yeah, he did his best to squash it. Senator Bernie Sanders, very excited that Howard Schultz did actually agree to come down and testify later this month. It will be interesting just if we get any insight. I doubt it because Howard Schultz is a pro at this, but any insight into how Starbucks has handled these unionization efforts, because you're right, the response from a lot of those employees that have tried to unionize has been extremely critical of the coffee giant. So this new CEO coming in also has his work cut out for him just in terms of helping grow the culture of the company and help resolve so many of these issues that I think has been holding back Starbucks for quite some time. And you look at the underperformance also of the stock recently, going back to last year, the worst year that it's had since 2008. So it does need something that's really going to boost the performance here going forward, and maybe getting more employees on board might do it.
You don't think it's going to be olive oil and coffee?
I don't think it's going to be
Oleato.
Dave thinks it's going to be olive oil and
Oleato.
coffee.
I think Howard Schultz
it.
is leaving a bomb for his replacement. I think that is a tough pill when you're an incoming CEO who he must have been on board with the olive oil drinks, but it was clearly a Schultz
You're excited
play.
to see, though, what else you learned from Thursday, right? At that investor day, sort of what is the grand plan here? Because, I mean, we're joking about olive oil and coffee, but if that's really as far as you can go, they've innovated a lot with products at this point. What new innovation can you bring? Is it something new with food? What can you bring that brings in more customers and gets more from our wallets? I don't think it is olive oil.
I don't know.
So can you do something different? Is it more rewards? You know, where do you get that next leg?
I bet you it's going to taste better than we think it's going to. I'm going to put that
I would
out
agree
there.
with that.
I wouldn't
We're
say
going
it's
to
going to
try
be
it
great.
here this week with our barista here at Yahoo, and we'll give it our own little
Okay.
sample. We do know they're doing a little bit of a reorg in stores to make the employee process a little more efficient. Is that a big investor story? Can't imagine that it is.
Yeah.
We shall see. It'll be an interesting investor day.
We certainly will see. All right, well, coming up next, President Xi Jinping visiting Moscow for the first time since Russia invaded Ukraine. But the Chinese president's top priority may have nothing to do with the war. We'll tell you why next.
Chinese President Xi Jinping met with Russian President Vladimir Putin today for 4 hours. The Western world watching closely as the pair is expected to discuss trade, political cooperation, and, of course, the war in Ukraine over the next few days. Joining us to discuss that meeting and what may come of it is the Council on Foreign Relations Fellow for International Political Economy and the author of the upcoming book, Sovereign Funds: How the Communist Party of China Finances Its Global Ambitions, Zoe Liu. Nice to see you. What is Vladimir Putin's goal with Xi?
Thank you, Dave, very much for having me. I would say probably President Xi Jinping's goal and President Putin's goal are going to be very different. On the one hand, President Xi Jinping might be really interested in restore China's global image, whereas Putin might want to discuss potential support that China could give Russia, both in terms of economic, financial, as well as perhaps military support in the war.
So how seriously do you think China and President Xi Jinping is considering that? When we talk about the timing of this coming just days after Vladimir Putin was charged of war crimes, how significant is that, and really just shows who China lines up with right now in the global world?
Yes, Yana, thank you very much for the question. I think your highlighting of the timing is really an important issue. And from where I came from, I would say actually this is not the first time or that President Xi Jinping visited Moscow or met with Vladimir Putin, right? So he actually has visited Russia 8 times since he came to power. And he has met with Putin on different bilateral and multilateral occasions for perhaps more than 40 times. And so under normal circumstances, this meeting would not be a major news. But this time, exactly as you said, is different in the sense that on the one hand, Putin is under international isolation and is wanted by the ICC. And then from Western observers' perspective, Putin really is, Xi Jinping's visit perhaps might signal that he is personally supporting Putin, and perhaps that might be interpreted as China's support to Russia. But I would say from China's perspective, this is very different because Xi Jinping, as the Chinese media highlighted, is at the invitation of Putin to pay a reciprocal visit following Putin's visit to China last year.
Economically speaking, what does Xi have to gain from Vladimir Putin?
So I would say probably there are one thing in particular, which is energy, and then related to that would be the use of non-dollar currencies in the pricing and the settlement of energy. So, latest data shows that the trade of goods between China and Russia reached about $190 billion last year, which is about 30% growth compared with a year ago. However, I would put this in the broader context of China's broader international trade, right? Because if you think about U.S. and China trade relationship, that is significantly outpaced to what extent China can trade with Russia. The bilateral trade number between China and the United States was more than $600 billion. So from that perspective, really China's trade with Russia is not as much as significant. However, if Xi Jinping, we put this in the context of the sanctions and all that, perhaps the use of non-dollar currencies in international trade is very much of Xi Jinping's concern.
Well, Russia and China appearing to deepen their ties. What does then all of this mean, though, for the U.S.?
So, Sienna, I think, what I am really concerned about is that, in the broader context, on the one hand, the U.S. financial institutions, especially, with all these discussions about SVB collapse and, the misuse of PPP loans. So basically what we are experiencing is perhaps there is an opportunity or even the threat that China might, or Chinese media might make this image or project this image that the U.S. financial system is built on a house of a card and all that, hence trying to reduce international confidence in U.S. financial in the U.S. financial system or even dollar-denominated assets. So this gives China and Russia, as well as some other interested countries, interest in promoting ways to bypass U.S. sanctions.
Arguably, the biggest discussion here regarding China right now is discussions over a potential TikTok ban. We're going to talk more about that later in the program. What is the Chinese perspective on that?
So that's an interesting issue, to be honest, because if Chinese foreign minister spokesperson sort of put a blush on it, saying that that's nonsense and all that. However, I do think there is, because of China's data regulation and the establishment or the launch of a new data governance bureau at the central government level, does raise serious concerns from Western perspective. However, to what extent TikTok really exposed a systematic national security concern, that we do not know. However, the perception of the threat because of this Chinese government potentially could compel companies to share their data with the government. That is a legitimate concern.
Zoe Liu, appreciate all that very much. Thank you. Coming up, Tesla unveils a major update to its full self-driving software. We'll go under the hood and check out the new changes. Next.
We all know the FDIC protects your bank deposits up to $250,000. But what if you have your money in a brokerage account or even a credit union? We asked Bankrate.com Chief Financial Analyst Greg McBride.
If you have money in a brokerage account, this is something different from the FDIC insurance you have with your bank. Brokerages, if they belong to the Securities Investor Protection Corporation, they have this SIPC insurance, and that'll protect you up to $500,000 in losses in the event that the brokerage firm goes out of business. Now, that just protects the fact that your securities won't be part of that liquidation. It does not protect you against investment losses, and that's a key distinction. The value of your account's going to fluctuate. SIPC insurance doesn't protect you against that. If you have money with a credit union, this is likely federally insured as well. The National Credit Union Share Insurance Fund provides, similar to the FDIC, $250,000 worth of coverage to credit unions. Before you put your money in a credit union, just make sure that they are protected by that National Credit Union Share Insurance Fund. Just like with a bank, you want to make sure you're putting your money in a place that's federally insured. But as long as that's the case, you are protected up to $250,000, just as you would by the FDIC at a bank.
Tesla shares holding on to gains after the company rolled out a significant update to its full self-driving software today, one that addresses a recall that the National Highway Traffic Safety Administration issued last month. Pras Subramanian, our senior autos reporter here on set. Pras, what can you tell us about this update that I believe is in beta, right?
Yeah, that's right. It's a big update here. A number of things that they've been sort of waiting on for a few months. They're going to merge some of the new FSD beta stuff with the autopilot highway on highway kind of autonomous features there. So in theory, that should make it better. You also have issues that are updating stuff with the close cut-ins with the cars and also things like lane blockage. But the big thing you mentioned is the actual potentially addressing some issues NHTSA had for the recall FSD beta. So a number of things are improvements with proceeding through a stop sign or stops at intersections, yellow light improvements there, improvements with speed adjustments when going to a speed zone. Also some scenarios where the car is actually going in a turn-only lane going straight through it. They've addressed that. So these are the four big issues here that they've addressed that NHTSA had an issue with. So presumably this will update those concerns and kind of address those concerns. And we haven't heard back from NHTSA yet, but presumably this is in concurrence with what they had said that they wanted Tesla to do.
Presumably that's why the stock's up too. All right, so Rolls-Royce going all electric in the next few years. Before that though, a V12 coming, a little gift.
One last chance with the Velvet Hammer, the V12 and the Rolls-Royce there, so we'll see the Wraith Coupe, one of their most exclusive sedans, coupes there. It's gonna go away for the Spectre EV, but one last chance when you get this car with the V12, special edition, special leather, special wood treatments. Only 12 of these cars will be made to correspond with the V12 engine. They start off at least $350K. You're going to see that go for a lot more for this special edition car here. So one last time for the glorious V12 with the Wraith.
You already got your name on the list, I presume, Pras.
Well, yeah, I need Dave Briggs' money for that. I'll try.
Please. Good to see you, Pras. Not so much. Coming up, we're counting down to the closing bell on Wall Street. Stay with us here on Yahoo Finance Live. All right, just a few minutes away from the closing bell. Let's break down the market action. As we can see, a lot of green on the board. In particular, look at the Dow, the leader on the day, up 1.2% just about. The S&P 500 rising 34 points, just less than 1%. And the NASDAQ has continued to increase a bit towards the close. A terrific week last week, best since January for the NASDAQ. And just when you think the markets are going to fall based on all this uncertainty, based on all the stress in our banking system, perhaps not. Perhaps they're seeing no Fed rate hike at the next meeting. I'm not sure what the sentiment is there. What do you make of it?
I don't know what the sentiment is. I think everyone's trying to figure out just in terms of what that contagion risk looks like when we take a look at the latest developments coming out of the banking sector. Yes, the fact that UBS did buy Credit Suisse. Yes, the fact that according to reports, there might be a second plan under consideration to try and help shore up some of the concern at First Republic Bank. You would think that that would help to ease some of those jitters out there on the street, David. When you take into account some of the losses, though, that we've seen over the last 2 weeks. Yes, the SPDR, the regional banking ETF KRE, did gain just about 1.5% today, but it did fall nearly 15% last week. So we still have a ways to go to get back to some of those levels that we were seeing 2 weeks ago.
Yeah, and you bring up the report from the Wall Street Journal about JP Morgan, part of that group that could stabilize First Republic. But after that report was broken by the Wall Street Journal, First Republic, which we'll talk about more later on the program, has continued to fall after that news and is now down 47%. I think it was down around 40 to 42 when that news broke. So that may have reassured the markets overall, but not investors in First Republic. So that story continues to evolve day by day, minute by minute.
It certainly does. Well, that is the closing bell on Wall Street. All three of the major averages holding on to gains. The Dow off its highs of the day, but closing up just around 380 points. S&P up nearly 1%. The NASDAQ up just about 0.4%. So the Dow, the outperformer of the day, closing up just over 1%. This market check sponsored by Tasty Trade. Let's dig into some of the big movers of the day. And first, that big news in the banking sector today. UBS buying rival Credit Suisse. That deal was reached over the weekend. Seeing how those two stocks performed today. Credit Suisse, no surprise there, closing off just about 52%. Flip it over, though, to UBS, because UBS was initially under some pressure, actually closed the day up just about 3%, so off the highs of the day. When we take a look at the street's reaction to this deal, it is a bit mixed, although there are a number of analysts a little bit more optimistic about what we are seeing. HSBC analyst here coming out saying that UBS's core wealth management and asset management divisions will certainly be enhanced by this deal, Dave. And then, of course, questions just about what exactly this means for UBS shareholders as well going forward.
I'm really curious how in the world you merge these two cultures. One, no risk. One, a ton of risk. It's like merging right now Democrats and Republicans in the United States, which is just an impossible task. How do you, obviously there's going to be some inefficiencies. You're going to have some headcount cut. But how do you merge two cultures that are literally diametrically opposed to one another and have been for quite some time? Also interested in, look, this is death by 1,000 cuts, clearly for Credit Suisse. But it does come on the heels and not too far after SVP. Did it somehow play a role? The timing of it is interesting. They have been struggling for quite some time, but the timing certainly intriguing.
The timing is certainly interesting, and yes, the whole banking sector was pretty much put on watch after that instability that we saw, which was triggered by the collapse of Silicon Valley Bank. When it comes to the recent fallout from Credit Suisse did bring some questions up about the internal financial dealings that were going on within the financial reporting, that of course was one of the triggers here. And then also the fact that Saudi National Bank, which is the largest stakeholder in Credit Suisse, saying that it would not raise its stake, currently had 9.9% stake in the company because of regulatory issues. That was enough to push shares of Credit Suisse off over 30% in midweek trading last week, which then of course came the action that we saw from the Swiss National Bank. So certainly a merger here, UBS agreeing to buy Credit Suisse. Huge news. We'll see whether or not that continues to stem some of the risk out there in the banking sector.
Paid $3 billion for what was worth $8 billion on Friday, and now is coming down closer to that $3 billion based on the stock action you just saw. Looked like a steal. Now it is coming back down to earth. All right, let's take a look at Amazon shares. Closing in the red after the company announced another set of layoffs. We spoke with D.A. Davidson senior research analyst Tom Forte, who's covering the tech giant. Here's what he had to say about today's stock move.
I think the stock's down because this suggests that the March quarter is not very good. So the fact that here we are on March 20th and they're doing another round of layoffs suggests that things are not going very well at Amazon, including the higher margin businesses, cloud computing, and advertising.
What are you expecting from the March quarter? How bad could it potentially be?
I think there could be continued weakness in the quarter. We're about to publish a white paper where we look at e-commerce sales in general, and our thesis is that e-commerce in the future will grow at a slower rate.
What was particularly interesting about these layoffs at Amazon today is where they came, not how they came. We knew that there was going to be more, and in fact, Tom says there will be more layoffs on the horizon, but they came in sectors that are typically very profitable for Amazon, in particular the two that jump out to you, advertising and AWS, which has been really the profit driver for Amazon. But he said, look, in a way, they've already done that in e-commerce, 100,000 through, this is attrition like you've never seen at Amazon. So they didn't replace around 100,000 people that left. Some believe that the stock action today was actually based on a report from Politico about Lina Khan and the FTC continuing to examine Amazon, looking at breaking them up and maybe blocking yet another deal. This one would be the acquisition of iRobot over data privacy concerns. And that is a story that will continue to play out with Lina Khan, the FTC. We've also seen it with the DOJ really taking an aggressive stance towards big tech.
Yeah, certainly. And I think that's one of the risks here going forward, although Tom Forte didn't seem too concerned about the FTC and some of the regulatory hurdles, at least in the near term, when it comes to Amazon. I think there's lots of questions just about the slowing growth that we have seen in Amazon over the last couple of quarters and how much slower that growth could potentially be over the next quarters, given the fact that the company is cutting from some of its divisions, which it relies heavily on, which has been very profitable for the company in the past. Andy Jassy, the CEO there, saying that it was because of the uncertain economy in which we do reside, that uncertainty that exists right now in the near future is forcing Amazon to become a little bit more streamlined and forcing the company to save costs where it can. There could be more cuts on the table. The size of those, though, is something that's out for debate right now.
Well, look, nobody has better data on the consumer than Amazon, and what they see generally tells of a worsening economic story. We learned that was their impression when they began to scale back plans for HQ2, their second headquarters in Virginia, dramatically cutting back what they plan to do there. So look, Amazon really has a great read, probably like a lot of the big banks here, on what is coming, and they do believe it is a souring economy.
All right, well, let's also stick with tech here and talk about Meta. That stock closing up today, up just over 1%. Now the move higher came after we got a bullish call from the street. Edward Jones upgraded the stock to buy after the Meta cut another 10,000 jobs. They announced those cuts last week. We want to bring in David Hager, the analyst behind that call. He's Edward Jones' senior equity analyst here. It's great to see you. So why are you more bullish on Meta given those cost-cutting efforts?
Well, certainly the company is paying a lot more attention to its cost structure than it was even when we go back to when it reported earnings after the third quarter of last year. And at that time, the guidance that was given for expenses for 2023 reflected a pretty significant ramp up, and the market certainly did not react favorably to that news. But since that time, the company's been taking a much stronger focus on the cost structure. And as a result, now with the second announcement of layoffs, we've seen the midpoint of their expense guidance come down by about $8 billion. And as a result, you put that against the lower expenses. Plus, we feel that revenue should start to stabilize this year as we get through what appears to have been an online ad recession. where we've seen online ad spending come down, and that's certainly affected Meta's revenue. But as we move through the year, we think they move to the point where that stabilizes and potentially even starts growing again due to the stabilization of the ad market. Plus, we see the impact of Apple's changes to its operating system, where it required users to opt in on ad targeting. That had an impact on Meta, and we're past the worst of that. And then the Reels feature and the click-to-messaging ads are both ramping in revenue, which should also start to help. So the net of it, we see an improving earnings outlook as we go through the rest of this year and into 2024. So kind of the combination of stabilizing and improving revenue plus the lower expense outlook definitely helps the earnings picture.
The exploding costs for quite some time were at least slated to be in the metaverse. How significant is the shift away from that, and where is the shift in focus going towards for Meta?
Well, certainly that was one of the issues when the report third quarter was the amount still being invested into the metaverse and the plans at that time, which seemed somewhat tone deaf to the environment in the online ad spending. And so since that time, they are refocusing, and more of the spending is going to be on towards artificial intelligence that will help with the ad targeting. Certainly the company in terms of targeting had struggled since Apple made its changes to its operating system. And I think investors would much rather see the investment going that direction towards their core business and improving the growth on online ad revenue.
And David, speaking about that, the ad revenue focus, are you starting to see signs of stabilization there? Because that has been certainly an area of weakness for the company, as well as a lot of its competitors.
Right. Yeah. And that's certainly been across the entire online ad competitors as well. It was, I think, encouraging when the company guided for the first quarter revenue, where for several quarters when they guided, the outlook was below where consensus estimates were sitting. But coming into the first quarter, the guidance was much more in line. And even at the higher end of that guidance could indicate flat to even slightly up revenue year over year. Now, our estimates were still showing a slightly down quarter for revenue, but it was, I think, encouraging that we're getting closer to the bottom and perhaps moving to where we could start seeing growth as we move into second quarter and beyond.
Do you factor in, David, a potential TikTok ban? What would that mean to Meta and to Reels' growth potential?
Well, certainly that's another factor that I think has been helping the stock lately. There's obviously a lot of news around a potential ban, and certainly nothing certain on that front. But even if a ban isn't enacted, it seems though that may be having some benefit to Meta, just as advertisers may be more worried about spending on TikTok and the uncertainty around that platform, which even just that may help shift some more ad dollars towards Meta, and certainly would help on the adoption of the Reels platform for advertisers.
Yeah, there was reportedly a meeting with TikTok and their biggest U.S. advertisers in which reportedly they were not all that convinced that data is safe from the Chinese government. David Hager, Edward Jones, Senior Equity Analyst. Thank you, sir. Appreciate it. Coming up, former President Trump says he expects to be arrested tomorrow. Find out how much this could shake up the battle for the 2024 Republican nomination. Next. Senator Elizabeth Warren had some choice words for Federal Reserve Chair Jerome Powell over the weekend. While discussing the fallout from the recent bank collapses on CBS's Face of the Nation, the Massachusetts senator voiced her opposition to Mr. Powell. Let's listen.
Jerome Powell has said that all he wants to do is lighten regulations on the banks. I opposed him as chairman of the Federal Reserve Bank precisely for that reason. I said he was a dangerous man to have in this position.
A dangerous man to have in this position. Let's welcome in Yahoo Finance senior columnist Rick Newman for more on this. Good to see you, sir. She reiterated on Meet the Press she does not believe he is the right person for this job. Not entirely clear how she thinks we should get inflation down. What's the fallout here, Rick?
Well, Powell's obviously under pressure. She's all over Jerome Powell's case. She's been bashing him in hearings for monetary policy, for raising interest rates in order to get inflation under control. She says he's just going to throw a lot of people out of work. That hasn't happened yet, but it could. And now she's going after him, saying he has failed with regard to regulation and the bank closures we've seen recently. I think it's a little bit premature, Dave. We know that the regulator for Silicon Valley Bank, the failed bank that got all these bank troubles going, we know that the San Francisco Fed, which regulated that bank, knew there were some problems at the bank. They raised some red flags, but they didn't do anything. So we don't have any reason to think that that's because Jerome Powell intervened and said, hey, let Silicon Valley Bank off the hook. That's where all my friends do their banking. The Fed has said it's going to provide a report on what exactly happened there. And that's really what we need. We need answers on what did happen. Why didn't the Fed do more to prevent that bank from failing? We should know at least a little bit more about that within, let's say, a month or a month and a half. Meanwhile, there was this law that eased regulations a little bit on mid-sized banks that passed back in 2018. Elizabeth Warren voted against that, and she now wants to change the legislation, basically go back to the way it was before that law. That is not going to happen anytime soon, mainly because Republicans control the House, and they're not going to vote to go back to the 2018 way of regulating banks. And it's not even clear that would have made a difference. So we really have a lot more to do on the postmortem to figure out what happened. But it's Washington, so, fingers are being pointed.
Fingers are certainly being pointed. They've been pointed now for quite some time, many times over the last couple of weeks. Rick, we've got to also turn to another potentially huge story this week. A Manhattan grand jury is deciding whether to indict former President Trump over a hush money payment that he made to Stormy Daniels. Now, Trump did take to Truth Social, a media site this weekend, to say that he does expect he may be arrested as early as tomorrow, Tuesday. Rick, what do you make of this? There are reports that barricades are now being unloaded near the Manhattan court. Do you think he's going to get charged?
Well, Trump never passes up an opportunity to portray himself as a victim. And that, of course, is what he's doing. And if you're on Trump's email list, you are getting fundraising appeals saying there's about to be this huge miscarriage of justice. Send me your money. But first of all, the Manhattan District Attorney, I don't think they have to arrest him to indict him. And it would actually be extremely foolish to do, a whole SWAT raid with the perp walk and, the agents with the long guns for the television cameras. That would be completely foolish to indict Trump in that manner and try to embarrass him. And, keep in mind that the Manhattan District Attorney is not the FBI, and it's known as a very conservative outfit. So I don't think the fireworks on this are going to be quite what Trump is previewing. But if they do indict him on this charge, it would be the first time that a U.S. president has been indicted. And I would add that it's a peculiar charge if that's the one they go after, this hush money payment. The hush money payment itself is not illegal. Under New York law, they would have to prove that it was the falsification of business records, and it might not even be a felony. So it's a weird case if that's what it ends up being, because it's certainly not open and shut. There's a chance they could lose, and there's a chance that people could look at it and say, this doesn't seem like that big a deal. But Trump, of course, is going to make it a big deal. So it's going to be an interesting week.
Yeah, they're likening it to almost how they got Capone, right? If anything, how do you think it impacts the 24 nomination? Does it just inflame his base? Does it hurt him in any way?
I think there's going to be so much more coming that this is not going to end up being very decisive. It looks like the bigger deal is going to be the case in Georgia, which is looking into election fraud. And that seems more significant, and it could end up being a better case. And then there's whatever comes out of whatever the Justice Department is doing with regard to January 6th, Trump's involvement in that, whatever was going on with all the classified material that Trump had at Mar-a-Lago. And there could be a lot of other stuff in that. So it feels like this thing out of the Manhattan District Attorney is like a little nibble of an appetizer that we may not even remember once we've gotten into the main part of this meal.
Eventful several months ahead. Rick Newman, as always, great stuff. Thanks so much.
Bye, guys.
Well, coming up, TikTok CEO is heading to Capitol Hill this week amid growing bipartisan support of a potential ban. Find out what could be in store when we come back.
The Federal Deposit Insurance Corporation, or FDIC.
FDIC. The FDIC.
The FDIC.
The FDIC, the Federal Deposit Insurance Corporation, was established during the Great Depression to restore our faith and our trust in America's banking system. But what does it do?
Its job is to protect your deposits that you put in regulated banks. Regulated banks will have a sign that says FDIC insured, and it will also say what the deposit limit is. The current cap is $250,000. The FDIC has a perfect record of protecting insured deposits. Not only that, but the policy has been, we did it every single time during the Great Financial Crisis. You'll have access to your insured deposits within one business day if your bank fails. For those who have more than $250,000, though, they should be aware that if the bank fails, they may not be protected.
So how do banks turn a profit? Well, they keep a portion of the money you deposit as cash or reserves to handle those day-to-day withdrawals. But the majority of your money is invested, and it's invested in mortgages, car loans, treasury bonds, the list goes on. And they make their money from the interest that's earned on those investments.
But sometimes banks do stupid things with your deposits. Yeah, doesn't happen very often, but sometimes it does. And that's why the FDIC is there. If the bank does stupid things with your deposits and loses too much money and becomes insolvent, the FDIC is going to swoop in and make sure that your insured deposits are whole.
Let's do a quick check of the market, see how things settled for the day. All three of the major averages holding on to gains, although closing off the highs of the day. The Dow up 382 points, S&P up nearly 1%, the NASDAQ up about 0.4%. This market check sponsored by Tasty Trade. Of course, a lot of the focus in the trading day was on those regional banks. First Republic Bank, that stock closing off 47%, closing at a new record low. Well, TikTok CEO Shouzi Chu is set to testify before Congress on Thursday as a debate around a TikTok ban in the U.S. intensifies and gains bipartisan support. Joining us now to discuss what's next for the social media platform in the U.S., we have Steve Pavlik, Renaissance Macro Research Head of Policy. Steve, it's good to see you. So it's certainly a high-profile showdown with the TikTok CEO heading to Capitol Hill. How do you see this playing out and potentially influencing a potential ban?
Well, I think this is sort of his last go around. He's going to have a lot of bipartisan, probably strong opposition just heading in there. And I think he's well aware of that. I think that's why you've seen TikTok just over the last week really step up its marketing here in DC and its lobbying and advocacy efforts. And I don't know at this point if it can really make that much of a difference. I think from, you mentioned earlier, bipartisan maybe legislation that now seems to be in the works. And that's important because prior to the midterms, I think some Democrats may have been a little reluctant to do anything legislatively because they didn't want to potentially upset that important constituency of younger users that use this app. Now that we're beyond that, I think more of these security threats are becoming apparent, particularly the story from the Department of Justice over TikTok spying into journalists. I think now just there tends to be a little more momentum here. And that's not in isolation because you had CFIUS, Committee for Foreign Investment in the United States, for years trying to resolve these national security issues with TikTok. And I think now there's some leverage here from the Biden administration saying, look, you can go ahead and divest and reach some terms here with CFIUS, or we'll go ahead and we have enough legislation, enough support here for legislation that can move to get the Commerce Department to ban it. That could put CFIUS in a difficult position because if they feel that lawmakers are going to go ahead and move forward and pass this bill, they may decide, look, we're not in a position to even honor these terms anymore because we don't want to get in the way of the legislators. And then if you're ByteDance and you're TikTok, you may figure, well, what's this point of reaching an agreement with CFIUS if it could all be mute here, in a few months. So I think it'll be interesting to see if he can sort of resolve these outstanding concerns from lawmakers with respect to data storage and the algorithm use.
Primarily, what are those national security concerns and how concerned should parents, for an example, be about using TikTok, their children, that is?
Well, as a parent myself, you have some different just concerns just in general with social media use that's probably not unique to TikTok. But from the national security perspective, I think the stated concerns are probably valid. And that is the potential that any Chinese company, when required to provide information over to the Chinese government, is forced to comply. There's no appeals process. So the ability for TikTok to gather information on US users, I think, is significant. And when you think about future applications, having data on people to realize benefits in artificial intelligence, I think that's one concern. There's another concern with respect to the ability to be a platform for Chinese communist government propaganda. You have young, impressionable minds here. When you think about people that grow up to be in positions of business and civic leadership, that provides a really desirable platform to potentially influence those minds in a very vulnerable age. And then I think we also see now, too, just growing concern over foreign interference in our elections. Again, the ability to have that platform is something I just don't think we're at risk. And then from just a bigger perspective, I think there's some concerns here when we think of technology, this blurring distinction between national security and economic security. From a U.S. technology perspective, a lot of U.S. social media platforms aren't given unrestricted access in China. So there could be an issue here of just some reciprocal market access that may need to be addressed. And there are a lot of opportunities for US firms to benefit. I know, Meta, I think one of your earlier guests mentioned in its Facebook Reels would be a logical beneficiary here. So I think those are some of the things that policymakers are trying to consider.
Steve, how would it ban, if in fact TikTok is banned, how would that ban work? How would it be implemented? There's lots of questions just about those backdoor ways that people would still have access to TikTok here in the US.
You're right. And to be fair, I don't have all the answers there. I think what you would have to start with is, can you go ahead and remove it from platforms like the App Store? Can you go ahead and restrict its use for commerce? I think that's where you'd have to start. Now, the ability for technology companies to actually go ahead and remove an app that's installed, that is beyond my level of expertise. But I think that's where we're headed.
Steve, do you think it should be banned? And what's the best way to go about it? Is it bipartisan legislation? Is it the Commerce Department?
Personally, I do think it should be banned. I was somebody who worked at the Treasury Department when we passed legislation to expand the scope of CFIUS. TikTok concerns actually came once I left the department, but just hearing what's been voiced, I don't think, particularly in this environment, that we should be vulnerable to this. And with respect to legislation, I think that's really important. The Trump administration tried to proceed with some bans of TikTok, and TikTok was able to successfully defend those in court, partly because they didn't have legislation to back this up. This legislation would give the Biden administration a firmer footing, presumably to prevail with a successful legal challenge. And I suspect that's one of the reasons they've come out and endorsed the legislation.
Going to be an interesting week on that front. Thank you so much, Steve Pavlik. Appreciate that. Coming up, Build-A-Bear Workshop recorded record profits last year. Its CEO, Sharon Price, joins us to tell us why she's predicting her company will have another record-breaking year in 2023. That's when we come back. Consumer sentiment falling in March for the first time in 4 months. The number sits at 63 0.4, about a 5% decline from February. That's according to the University of Michigan. The data was not tied to the fall of Silicon Valley Bank. 85% of survey respondents were completed prior to the bank's collapse, the decline representing a broader look at the state of the consumer amid high inflation and macroeconomic uncertainty. Despite that uncertainty, one company is coming out on top. That is Build-A-Bear Workshop, recording its most profitable year in 2022. And now the company says it can beat that number in 23. Joining us now is Sharon Price. John, the president and CEO of Build-A-Bear Workshop. Nice to see you. Thanks so much for being in studio. How do you explain that record year in 2022 when the consumer is beginning to cut back and trade down?
Well, I think that a lot of it has to do with Build-A-Bear being such an important part of celebrations and memory making. And we also happen to be in a situation where we expanded our addressable market to be 40% of our sales are to teens and adults with collectibles and gifting. And there's just a time right now in I suppose it's related to post-COVID environment when people just want to be a little more lighthearted and have some fun together and get back out and shop together.
You say adults are
it's called kidulting now.
Okay.
It's a big trend.
The After Dark platform.
Exactly. That's a really good example of that. We actually, when we launched that a few years ago, had some pickup, but last year when we brought it out, we had 1 billion media impressions in a single week because people, I think, just really want to be a little more lighthearted. And you know what? It's about time.
And something that certainly helps there is that adults are the ones with the money at the end of the day. And certainly we've seen price points across the board really increase here, inflation taking a toll on all consumers' wallets. And so walk us through, how have prices changed in the past few years to Build-A-Bear? Are they more expensive, and where are you seeing higher costs specifically?
Well, one of the things that we can do, because we're a vertical retailer, we conceive, manufacture, ship everything, do everything ourselves, so that ultimately it's in the store. It's our store, right? So we're able to have a lot of price discretion, and we're very careful in the way we use that discretion. Some of these collectibles, as you kind of alluded to, that are targeted toward the older consumer, like Ted Lasso or the Harry Potter products, we have a little more price latitude there. Now, we always want to be accessible particularly to our kid consumers. So we also have on the other end a low entry-level price point, as well as our birthday treat bear, which can be up to, our birthday's about a third of our business, where you can come in on your birthday month and buy a birthday treat bear for the age you are turning. So if you're turning 1 or 2 years old, you can come in and get an entire Build-A-Bear experience, including putting in the heart, going through the ceremony for $2. So there's a way to get a furry friend.
My birthday will cost a little bit more than that.
Well, you don't have to use the special.
But when you think about the physical footprint that you guys have, of course, you're also expanding in digital. You launched in the metaverse and Roblox. You announced a partnership with Hello Sunshine.
Yeah.
How do you envision the future footprint of Build-A-Bear? Are more people shopping in the store, or are they just ordering a bear online? Takes away from some of that personalization experience, maybe.
Well, that's a great question, but you have to understand, as we've expanded our addressable market and we're multi-generational, we turned 25 last year, all brands need to think about how they can meet the needs of the guests where the guests want you to be, right? So on the collectible side, sometimes that older consumer really does want to do the most frictionless, fewer clicks, I just want my next Pokemon. But the kid, usually the family, now growing number of teens, want to come into the store and go through the experience and create memorable moments, maybe even some social moments that they can share. So we want to be there for everyone. And so that expansion into Roblox, that's because that's where kids want to be. Media's changed dramatically, and expansion in entertainment. We've sold 225 million Build-A-Bears in the last 25 years. But for us, that's just not a stuffed animal. That's 225 million stories. We've always been a storyteller. So, of course, we've expanded into content creation. And it's just been a great, just getting off the ground with Reese Witherspoon's company. Hello Sunshine has been a great start for us. And we already have movies in the pipeline, yeah.
You had me at Ted Lasso, of course. That's a bear I would take a selfie with. But these partnerships, presumably that one with Apple, Warner Brothers Discovery with Harry Potter, Disney with Star Wars, and so many Disney characters. How do those work? Is there one that jumps out as a bestseller? Do you have any insights on that regard?
We have a lot of bestsellers, and we really value our best-in-class partners. So I think it just, you have to look at it on to whom and why. So, you know, Harry Potter is an evergreen property for us, and that would be like Pokemon. Some of these properties, we do them sort of as a one-off, as a punch, something that's going on in the zeitgeist, like the Elvis bear. So that serves a different purpose for us. So for us, we love all our furry friends. And they do allow us to push into different spaces. Sometimes those...
That arrangement, you pay Apple, you pay Warner Brothers, you license those from them?
We license the intellectual property from those property owners, yes. Just like other people license our intellectual property.
Sure.
Yeah.
Is it a certain timeline that you look at, or really limited time offers and also potential longer rollouts as well?
It depends on the property. Like for an evergreen, like a Star Wars, it's been multiple years for us. But a shorter, maybe sometimes it'll be just a punch on a feature film, and that'll be a shorter license.
Now, I do want to quickly touch on, you do have a new book out, and it's really about finding value in your moments that you've had as CEO of Build-A-Bear, but also values that you've used to really propel your story forward. The story of Build-A-Bear, what do you think is the biggest lesson that you've learned during this role and leading it during the pandemic?
Oh, that's such a deep question that does require a lot of reflection. So much reflection, I had to write a book about it. No, just kidding. But Stories in Heart is about unlocking the power of your personal stories to create a life that you love. And it really does highlight different moments in my life, all the way back to childhood, but ending with 2 chapters about Build-A-Bear, where there was a tremendous amount of introspection leading this company through COVID, the retail apocalypse, Brexit, a lot of ups and downs. And I think that some of that reflection has allowed me to become a better leader over time. It's always a journey. You never get there. But I think just coming in every day with an open heart about keeping your consumer in the center, your brand in the center, and always balancing that with the needs of our investors, our board, and all of our stockholders and shareholders. I think having an open approach to try to drive value with everyone in mind has been of great benefit.
That's a great lesson. You've come out the other side doing awfully well. Sharon Price John, CEO of Build-A-Bear Workshops. Wonderful to have you here. Thanks so much.
Thank you so much for having me.
Thank you.
All right, coming up, Netflix is looking to create some buzz in an area other than streaming. See how the company plans to bulk up its gaming portfolio in 2023. Next.
The battle over remote work is having a huge impact on commercial real estate. Office vacancy levels are nearing their highest level that we've seen since the 1980s. This is all according to new data out from Moody's Analytics, and that's due to several factors, among them the rise in remote work and also this higher interest rate environment. Let's talk about it with Emily Peck, Axios markets reporter. Emily, it's good to see you, and I know you've been digging into this report from Moody's. Just paint a clear picture for us. How dire is the situation right now within commercial real estate?
So I wouldn't say it's dire. Commercial real estate never gets to dire. It's been sort of this slow moving crisis unfolding over the past 1 or 2 years where, we're all working from home. I'm home right now. Companies need less office space. Offices, vacancy rates are creeping up. And at the same time, interest rates are rising, making it harder for landlords to keep going. So we have seen a slight increase in some landlords, defaulting, walking away from certain buildings.
Are we seeing a plateau when it comes to the return to office, or is it still a moving target?
I think we're getting to a new status quo, a plateau, just like you said. In some cities, offices are about 50% of where they were before the pandemic, and those numbers really aren't going higher. So there's there's basically a reckoning going on right now in the space. Everyone's coming to terms with the fact that, there is no going back. Remote work is here to stay. Companies don't need as much office space as they used to.
I'm going to challenge you on that, though, as we've seen the tech layoffs continue to build, and a lot of those CEOs start saying, hey, we want you back in office as this economy begins to sour and layoffs continue. Don't you expect that number to continue to climb in terms of people coming back to the office?
I don't know that it's going to climb. I think the tech sector is unique, and we have seen companies call workers back, but it's not going back to 5 days a week. I think there's an expectation for hybrid work now, and that's the difference. I think you might see at the margins a creep up, but most of the people I'm talking to don't expect, to go back to the days of 2019 when everyone was in the office every day of the week, maybe except for Friday.
Emily, there was a piece in the Financial Times EFT over the weekend, got our attention. I know it got your attention as well, linking SVB and the risk that they took in their portfolio to their work from home, their remote work culture. And there was one Stanford professor quoted in this article saying that ideas like hedging interest rate risk often come up over lunch or in small meetings. I'm having a very tough time linking these two. Help it make sense for me.
Yeah, that was a very specific quote. I'm not sure what to make of that either. I think the big picture takeaway from SVB, we know this bank failed for bigger picture reasons because interest rates, rose really quickly. They had too much long-term bonds on their balance sheet, et cetera. Remote work, more like a symptom than a core problem, and an easy target for people to blame. And certainly Silicon Valley Bank was an outlier among other bank peers, and that it was remote, touted its hybrid and remote work, on its recruitment site, which is really different from other banks. So when it's time to do the autopsy on the failure, it's sort of easy to point to that instead of, blame management or other things, right? It's like, well, it's remote work's fault, surely. But I'm not sure if it really is.
Yeah, I'm having a tough time buying that. But Emily, do you see this at all impacting maybe how other banks operate? If there are remote workers inside other banks, obviously we know a lot of the larger banks have already brought back their employees to the office. Do you think more people within that sector are going to be forced back into the office?
Yeah, I think a story like this, a lot of people read the FT story or my story in Axios. I think a story like this spreads really far and gives ammunition to managers and executives who want to call workers back. I did hear from a few folks in banking that were like, why did you publish this story? My boss is just going to use it to make me come back in all the time.
And certainly some questions about all this. Well, Emily Peck, good to have you. Thanks so much. JP Morgan doubling down on Netflix. They're bullish on the streaming giant and saying that investors should buy the dip. Yahoo Finance senior reporter Alexandra Cannell joining us now with more. Allie, the key takeaways of it, JP Morgan, very encouraged maybe by what we'll see from Netflix here shortly.
100%. They were out with a new note earlier today encouraging clients to buy this pullback that we've seen in the stock. And this despite some very near-term noise surrounding the password sharing crackdown. We know that has been a big pain point for customers, and it's been reflected in the stock price. Shares are down about 4% since the company's latest earnings report, which was largely positive. The stock has given up more than 17% of gains since hitting a year-to-date high on January 26th. And there has been further pain after the streamer slashed prices in 100 overseas markets. So certainly near-term noise, near-term risk, that has indeed impacted sentiment. But analyst Doug Amick from JP Morgan reiterated his outperform rating and price target of $3.90 a share. He argued that he's still bullish because initiatives like the crackdown on password sharing, like ad-supported, like solid content, that will drive revenue, margin expansion, and free cash flow in 2023. So really focusing in on the long term. Now, what that means for the short term, that remains to be seen. I think the hysteria that we've seen surrounding the password sharing crackdown, it's going to push that rollout in the US potentially to the second quarter. There's only a few days left in Q1. Netflix initially said that the first quarter, that's when we'll see all these changes. But so far, we haven't seen it hit the US yet. And I think a major part of that has been all the negative headlines. But there have been some positive headlines. And over the weekend, we did get this from Bloomberg reporting that the ad tier service for Netflix reached roughly 1 million monthly active users in the US in its second month on the market, and that the user base grew by more than 500% in the first month and then 50% in the second month. I did reach out to Netflix. They declined to comment on the Bloomberg report and said that the only external subscriber data is what they have provided in earnings. We'll see if we get any updates when the company does report first quarter earnings on April 18th. I know investors are going to really want to focus on that and any potential updates there.
Netflix also confirming a big move in the gaming space. What's the investor side of that story?
The gaming story is interesting. They did announce in a blog post that they have 70 games in development with external partners, additional 16 games in progress at the company's in-house game studio. They have released 55 games so far. About 40 more are slated for later this year. So it does seem like gaming is a potential, actually no, not even a potential, it is part of the strategy. I think the big question though, and I've heard this from investors and from analysts, is how important is it going to be for Netflix in the long term? I think at the end of the day, they're really trying to diversify. We've seen that with some of their live content, like the live Chris Rock special, some of the ways that they've been trying to integrate more sports content on the platform, not necessarily buying sports rights, but leaning in on more documentary style pieces to try and lure in that type of viewer and user. I just am not convinced with the gaming side of things right now.
I'm just looking it up now because I
never use games.
Yeah.
I don't know of many people.
I don't think I'm the target. Yeah.
It's just mobile, right? I mean, it's not for my.
From my understanding, yes.
Huh. Interesting. Yeah. I've never known anyone that used Netflix for gaming. Have you?
I've not, and that's why I'm not fully convinced. It is still early days. I do think maybe we need more time to see how this all shakes out. But I just think that there are other things that Netflix needs to worry about besides just gaming. But we'll see.
I'm
He's looking at him now.
Gaming, someone that's never gamed before. We've already lost you. That proves that maybe Netflix is onto something here.
Maybe.
I don't have enough. I don't have enough time on my hands.
I'm
not a gamer, man. But the huge market. Allie Canal, thanks so much. Great stuff. All right, coming up, we'll break down some of the biggest takeaways from today's top financial stories. Stick around. It's closing time here at Yahoo Finance. Let's get you caught up on some of the biggest stories of the day. Swiss banking giant UBS will buy troubled rival Credit Suisse for about $3.2 billion. Credit Suisse had in recent years been plagued by mismanagement and scandal. The hastily arranged takeover helped inject some calm into the markets, with stocks ending the day higher.
See whether or not that holds. All right, well, now to Amazon, which announced a second round of layoffs. CEO Andy Jassy telling employees that the company was cutting 9,000 jobs. Now, that's on top of the 18,000 jobs that the tech giant has cut a few months ago. This time, the cuts will hit members of the cloud computing and advertising businesses, along with its HR department and Twitch streaming service.
Chinese President Xi Jinping meeting with Russian President Vladimir Putin in Moscow. The meeting comes just days after the International Criminal Court accused Putin of war crimes in Ukraine. The visit is probably not what ByteDance, the Chinese owner of TikTok, wants to happen this week. TikTok CEO is set to be questioned on Capitol Hill Thursday about the security threat the app poses.
All right, well, that will do it for us today on Yahoo Finance Live. Thanks so much for tuning in. We'll see you right back here again tomorrow, 3 p.m. Eastern Time. Have a great night.